Hello and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein. And today we're going to talk about what are the best loans for rental properties. If you're buying 1 to 4 unit properties, single family, duplexes, triplexes, or fourplex, the best way to financing them would be with a conventional loan, most likely. I'm talking the best way to finance them for pure interest rate and term. You can't beat conventional financing. If you're buying a cash flow asset and you have to take a portfolio loan at 6%, but you're still cash flowing, does it make sense? Of course.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein. And today we're going to talk about what are the best loans for rental property. All right, so let's dive in. Let's say when I'm talking rental properties today, I'm talking 1 to 4 unit properties. Okay, so if you're buying 1 to 4 unit properties, single family, duplexes, triplexes, or fourplex, the best way to financing them would be with a conventional loan, most likely. I'm talking the best way to finance them for pure interest rate and term. You can't beat conventional financing. You can get rates in the threes on non-owner occupied property fixed for 30 years. I mean, the rates are insane right now, but not everyone is ready to bring on extra debt. Some of the downfalls of conventional underwriting is that they're looking at you as more of an individual. So they'll take your income and they'll take any rental properties you do own and all your liabilities, and they'll figure out if you have your front end and back end debt ratios, right? So a lot of times investors getting started or more experienced investors have too many properties because they underwrite only at 75% of gross rents on those rental properties. So you can quickly not be able to qualify anymore using your income.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
And now a word from our sponsors. Want to save money on your taxes? Cost segregation is a strategic tax planning concept that saves money by deferring federal and state taxes through accelerated depreciation. Get a free benefit analysis today. Please visit costseghub.com for more information on cost segregation and all of our cost recovery services that can put more cash flow in your pocket.
So the best way to look at it in the beginning is if you're bankable, try to go that conventional route to get conventional financing because, like I said, 30-year fixed rates, no prepayment penalties, typically in the threes. So could be a great option for you, right? The cheapest cost of capital. Now, for some, it's not realistic. They might have self-employed income. They write off a lot of stuff. They don't have enough income that's shown on their tax returns to qualify. So there's bank statement programs where there's debt service coverage ratio loan programs specifically for real estate investors on the rental properties. The downside is that these are not as attractive as far as terms. So when you're underwriting your deals and figuring out, do they pencil out? Does it make sense from the investing strategy? Know that if you're not getting a bank deal, you're going to be getting rates a little bit higher, which in some circumstances is fine. If you're buying a cash flow asset and you have to take a portfolio loan at 6%, but you're still cash flowing, does it make sense? Of course. That's like when we're flipping houses, we borrow money at 10% and 2 points sometimes, or 12% and 2 points, because we need to make the deal work. And we know we factored in the cost of the capital. And when we sell the property, we're going to make a lot of money. So we're okay with that. So that's what we have to consider. But definitely conventional financing. You can also do a lot of my investor clients are burring properties right now. They're going in, they're getting maybe a fix and flip loan to lend 85 to 90% of purchase, 100% of repair costs. they're fixing up the house and then they're refinancing down with conventional down the road after they put a tenant in the property. They're getting all their money back and sometimes more. Sometimes they have to leave a little bit of money in, depends on the ARV of the property. Conventional financing and most portfolio financing goes to about non-owner occupied property. It usually goes to about 75% of the value of the property. So you're not going to get super high leverage on your rental financing. And on the portfolio loans, we look at, as opposed to conventional, that's looking at your debt ratios. On portfolio loans, we don't ask for tax returns. And I'm talking non-bank or credit union portfolio loans. There's a whole nother world with bank and credit union portfolio loans, but the portfolio business over here doesn't ask for your personal tax returns. They're looking at your experience, looking at your credit score. They're looking, most importantly, at the debt service coverage ratio of the assets. You know, how much income versus how much the debt payment is on an annual basis. And you figure out your debt service coverage ratio. So that's what you want to look at, those different options. But getting started, or even as advanced investors, it's okay to buy in your name. Obviously, talk to your professionals, what structure they think is the best. Maybe they recommend an LLC, or for different reasons for taxation and things like that. But strictly, if you're buying in your name in the beginning, you can get 6 or 7 properties, and then you can do a portfolio loan over here in the business entity and refinance those properties in the business entity. And then it frees up your personal credit, because all those conventional loans are showing on your personal credit report versus these portfolio loans over here. They don't show up on your credit report. They're owned by this entity or business of yours, and you're the manager or whatever you are, president, treasury, whatever your position is in that company. So it's not on your personal credit report. However, a lot of these loans are recourse, meaning you do have to sign a personal guarantee, even though the loans are made to the business entity. To go full circle with this, my recommendations is always, if you can go conventional, you look there first, build relationships with really good mortgage brokers that have good relationships with the local bank, credit unions, and that thing, because you want to know what your options are. And strategic financing can really help you grow your real estate investing business, knowing what your options are and figuring out realistically, based on where you're at now, what the best financing is, and depending on the condition of the property. The downside of conventional financing for investors is that if that property is missing a kitchen or something like that, or needs repairs, sometimes you can't get conventional financing on that property. You have to do. So that's, another reason why you might want to use short-term bridge money to take down these properties and then refinance with conventional financing. Anyways, hope you enjoyed this, another short episode of the Investor Financing Podcast. Please like, subscribe, and share with your colleagues, and I'll see you on the next episode.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.